Welcome back. Today we're doing Target, ticker symbol TGT. They have a $127 billion market cap and are selling for $260 a share. So why are we doing Target? They have earnings coming up on Wednesday, so I wanted to do a review of the financial statements and see if the current share price is justified, if this could be a buy, if the earnings could be a catalyst for it to continue growing. So in the description, I've copy and pasted a description of what Target does just from their 10K, so you can read that. But I'm gonna go straight to the share price history. So look at this. This is a 5-year trend. Over the last 5 years, it's going almost exponential, right? It's going up 240%, about $180 per share. That's incredible. We're gonna see, was that justified? Could it continue? So let's do that by first looking at the income statement. All right, so first thing we're going to look at is total revenue. This is the top line item. This is always the first thing you want to look at, really just to make sure it's not decreasing. So this is every quarter going back to 2006. You can see we had a modest rise for a while, and now recently it's really starting to ramp up. So that's a great sign. We like seeing that. All right, let's move to gross margin. So gross margin is what I love to look at to see a company's competitive strength, right? Because if it's having to sell at low margins, it means it's having crazy competition. If it's selling at high margins, it means it can pass on a high cost to its customers without having to worry about losing market share. So I've said this before, but in general, between 20 and 40 is okay. Over 40 is great, under 20 is bad. So they're in the okay range, pretty flat. I mean, if anything, it's decreasing a little bit, but that's nothing to really concern me. Flat margins okay, especially with all the increased competition from online sales. I'm actually okay seeing flat margin. A lot of other retail companies have margins that are decreasing a lot faster, so I like to see at least flat line with these guys. All right, moving to our first valuation metric, that's going to be our pre-tax income. So pre-tax income is just like it says, the profit you make before you pay taxes. All right, so look at this. Well, I found the reason why the stock price went up so fast recently. Look at this. Because remember, this is the last 15 years. So like in the last 3 years or so, I mean, you've more than doubled your quarterly pre-tax income. That's awesome. I love seeing that. Wow. All right, so what number are we going to use? So the valuations we're going to use are very dependent on the inputs, and pre-tax income is one of those inputs. So you want to pick what you think it's going to be. I'm not going to be super aggressive and project it higher, but just from reading a little bit about the company, I know that this increase is mostly due to online sales that they've started growing. So I don't really see it decreasing. I don't think that this is a peak. I think at worst it flatlines. That's just my opinion. Everybody else can have a different opinion. So what I'm going to do is I'm going to take this 2.5 billion per quarter and get a yearly pre-tax income. So 2.5 billion times 4, 10. So that's going to be our pre-tax income I'm putting over here in the outline. All right, and next is a growth rate. So it's actually pretty hard to get a growth rate looking at this trend. I'm going to do something I usually don't do, but I'll tell you why. So I'm going to go back to the revenue, and I'm going to get my growth rate based on the revenue because our margins were flat. I usually do not judge growth rate of a company on revenue because they could be growing revenue but just be having shrinking margins. But since their margins have been flat, I'm going to use their revenue just because it's a much easier calculation. All right, so we're going to go back about 5 years and go pit to pit. So you can go peak to peak or pit to pit. So I'm going to go pit to pit. So 5 years, that's about right here. You were making about 16 billion a quarter, and now our pit is 24. So what we're going to do up here in the calculator is 24 divided by 16, and you raise that to the 1/5 because it's 5 years, and we get a growth rate of 8.4%. I'm going to round down, so I'm going to say 8%. All right. Let's go to our diluted earnings per share. All right, so wow, look at this. This is almost exponential too. This is awesome. So this is a better growth in the pre-tax income. That probably means they have a lower number of outstanding shares, so that's great to see. I don't know that, but we'll look at it in the balance sheet. So the formula we use here calls for the trailing 12 months, so that's easy. You just sum this quarter, this quarter, this quarter, and this quarter. So I'm going to do that here at the bottom. You can't see the sum, but it's off screen. All right, the last 4 quarters sum to $12.56. So $12.56, that's going to be my earnings per share number that I put here. So $12.56. All right, awesome. Incredible income statement. If that growth continues or even flatlines, I think it's going to be pretty solid. All right, let's go to the balance sheet. First thing we're going to look at is tangible book value. Remember, this is also called tangible equity. It's called net tangible assets. This is everything a company owns, all of its assets, minus everything it owes, all the liabilities, and we've subtracted out intangible assets, things like goodwill. So this one's going to be interesting because I always say you want to look at a company's tangible book value because that tells you its liquidation value, its net worth, and if it's not growing, you should be extremely suspicious. So I'm suspicious here, but I want to show you why this company is a little different. So what I'm going to do next is show you the tangible book value per share. So we'll go down here, tangible book per share. And this is that same number just divided by the number of shares. So look at this. So this is much better. So we are growing, and recently we're growing significantly. So I love to see this. This is great. What we're going to do now is get our return on tangible equity on an after-tax basis. So this is per share. So we're going to use our earnings per share number, which was $12.56, and divide that by our tangible book per share, which is 30. You always use the most recent. Divided by 30, 42% return on tangible equity. Incredible. Now we're going to get a tangible price per book value. So what we do here is you take the share price, which is $260 per share, you divide that by this 30 here, and we get 8.7. And I need to put a T in front of that PB because it's tangible price per book. So 8.7 is pretty high, but that is okay whenever you're getting that great a return on your equity. I think that the balance sheet's strong. Last thing I want to look at with the balance sheet is the number of shares, just to kind of confirm what we thought earlier. So I'm going to go here to ordinary shares number, outstanding shares, decreasing. Awesome. So decreasing shares is great. That's like the opposite of dilution. This is a company saying we're decreasing the number of shares because we think our share price is undervalued. So if a company is lowering that number of shares, that's usually a great sign. So the balance sheet also gets a huge check mark from me. All right, let's go to the cash flow statement. First thing we're going to look at is free cash flow. All right, so we like to see this growing. Free cash flow is going to be a lot more volatile than pre-tax income or just the income statement in general. So just keep that in mind. Never judge a company based on one or two misses on the free cash flow. You need to look at it in aggregate. All right, so just like our pre-tax number, we're going to kind of get an estimate. So I'm going to follow this recent trend here and just kind of split the difference between these dots and say we're going to be about $2 billion per quarter in free cash flow. So I'm going to do 2 times 4, 8. Tough math. Good thing I have the calculator up there. All right, $8 billion per year is our free cash flow estimate. And we're going to look at dividends because if they are paying dividends, it would make that growth in equity even more impressive. Because I know I harp a lot on watching the tangible equity grow, but it's okay if it's not growing as long as the company's paying a lot of dividends. So look at this. They're spending $300 million a quarter in dividends. That's good to see. So not only do we have growing equity per share, but they're growing that equity per share while also sending money out in dividends. So great sign. Love to see that too. Let's move to the valuation. All right, so our first one, our rule of thumb method, is going to be our pre-tax income times 10 divided by the number of shares. So let's do that. $10 billion times 10 divided by the number of shares outstanding. So 488 million. And we get a target share price of $204.9 or $205 per share. All right, the next one is going to be our Ben Graham formula from security analysis. Earnings per share, 12.56 times 8.5 plus 2 times your growth rate. So our growth rate was 8%. All right, awesome. $308 per share. I'm rounding up. All right, and last we're going to do our discounted cash flow. That's not going to be done on the calculator. We'd be here all day. I got an Excel sheet to do that. So we're going to take our free cash flow, which is $8 billion, perpetual growth rate. Usually I slash the growth rate that I got in half, but I think that we can expect some serious growth from Target, especially from the online sales. So I'm going to put 6%. You can put whatever you want. And then our discount rate is going to be 15%. That's always my discount rate. Everybody can have a different discount rate. And we get a net present value after 100 years of $102 billion. So I take that 102, divide that by the number of shares outstanding, and we get $210 per share. So we got 3 valuations. 2 of them came in below the share price and 1 of them came in above the share price. They average out to $240 a share, so a little bit lower. Does that mean that you should stay away? Definitely not. I think that this company has a lot going for it. If it continues to grow, I think that the intrinsic value definitely grows into that current share price and that it could even push it higher. And that's why I kind of included that quote from Warren Buffett that, it's better to buy a great company for a good price than a crap company just because it's cheap. And I think that this is a chance to buy a really good company, but don't take my word for it. I encourage you to do your own research using everything that you learn here. And if you did learn something, if you enjoyed the video, please like and subscribe, and I will see you next time.